Hello, everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much, much more. My name is Sava, and today we're discussing option valuation using the Black-Scholes model. We want to figure out how to assign fair values to options, puts and calls, with particular characteristics. Obviously, we have already discussed options in great detail, what they are, how you can come up with investment strategies to capitalize on your forecasts of underlying share price. But we always considered the premia of put and call options that we are buying or selling as a given. And we have never actually discussed in great detail where do these premia originate from? How do they correspond to the underlying characteristics of particular options? One of the simplest and one of the most famous models that basically intertwine the option premia and their characteristics of the underlying share price and the details of the option contract is the Black-Scholes model. And today we are analyzing what this model is all about on the case of HSBC stock and existing options for the HSBC shares. So our case is very simple. We are starting to trade options for HSBC on the 24th of December 2019, so right before Christmas, and we take options with the expiry date at the 17th of April 2020, which is, again, the third Friday of April. Typical option expiry dates for any option exchanges. The share price at the end of the trading day on the 24th of December has been slightly below £6 per share, so 599.4 pence per share, and we'll be trying to value calls and puts for the strike price of 600. If I may remind you, generally strike prices are round numbers that go in particular increments. What we need to figure out to perform the valuation first is what is the maturity of the option in years. So how much time will pass from today when we want to buy or sell a put or a call and the expiry date when it will be exercised. Again, here we are assuming that it's a European option, so it's exercisable just on the expiry date, on the maturity date, not at any day from today until the expiry date. That would be an American option. So we're just considering what would happen at the very end of our trading period, at the expiry date at the 17th of April. So the maturity in years would be just the difference between the expiry date and the start date. That would give us the number of days that will pass from today until the expiry. But to get it in years, we need to divide it by 365. Well, because there are 365 days in a year. And obviously, it is not as precise as we could go, because we are concerned only with trading days. So ideally, we might have wanted to figure out how many trading days are between those two dates, and then divide by 252, for example, the number of trading days in a year. But that estimation is also very accurate, so you can stick with that. So we apply this formula, and we see that the maturity is roughly a third of the year, so 0.32 years. Why do we need maturity? Well, remember, options are beneficially exercisable if the share price moves either out of the money or in the money. So options allow you to capitalize on upward or downward volatility. And the longer the time period that will pass from today until the expiry date, the more relevant events can happen with regards to the underlying company, and the higher the magnitude of share price movement might be. Time is essentially volatility defined in other terms. So if the maturity is higher, then the expected volatility, so the expected magnitude of share price movements that might happen within the trading period, is higher. So the options would be more valuable if they are for higher maturity, if the expiry date is further away into the future. Then we need the risk-free rate, which is 0.77%. Roughly, that is the yield to maturity of UK short-term government bonds at the current date, so 24th of December 2019. The risk-free rate is required for discounting and to accommodate for the fact that generally we expect all share prices on average to appreciate over time because of the present value considerations and time value of money considerations. Then we need to estimate the volatility of the underlying share price, and we need to estimate it on an annual frequency, because obviously we have the maturity in years and we have the annual risk-free rate. So how to estimate annual volatility of a particular instrument? Well, to do that, you can just get daily stock price data for your underlying share price. Here, I've got it from 24th of December 2018 all the way until 24th of December 2019. So the very last day that we are aware of when we start trading, because obviously we can't use the data that's unavailable to us at the moment when we start trading. And how far back do we need to go into the past to estimate historical volatility is an open question. You don't want to go too far back because, well, the events that happened back then might not be relevant for the situation the company is in today. But you don't want to be too short-termist as well, as the larger the sample size, the more precise is your estimation of volatility. So here we use 1 year worth of daily data. To calculate daily volatility, we just need to estimate daily returns. Again, share price today divided by the share price yesterday minus 1. And we bottom right click it all the way down and get all daily returns. And then we can calculate daily volatility by just applying the standard deviation for the sample function. And we select the whole array of returns and get 1.07% daily volatility. Then we need to annualize this volatility. Well, we can use the random walk assumption so that the stock returns are independent of past stock returns and that the share price follows a random walk, and just multiply the daily volatility by the square root of the number of trading days within the year. And we all well know by that point in time that there are on average 252 trading days within a year. So when we multiply it by the square root of 252, well, because variance of independent events scales linearly, so standard deviation scales the square root, we can just multiply by the square root of the number of trading days. And it will give us roughly 17% annualized volatility. Well, now let's discuss the heuristics that we want to be fulfilled and manifested in our option valuation model. In any option valuation model, we want to accommodate for three main stylized facts. How do strike prices of options, maturity and volatility contribute to option premia? We have already discussed that strike price affects calls and puts differently. If the strike price is higher, then calls would be less valuable and puts would be more valuable, because it's more valuable inherently to buy something cheap and to sell something expensive. But regarding maturity and volatility, as we have already discussed implicitly, both calls and puts should become more valuable when volatility or maturity increases, because with increase in both volatility and maturity, the share price at the expiry date is more likely to move either in or out of the money, so it will positively contribute to the value of optionality regarding both calls and puts. So for any option valuation model that we can consider theoretically, those three stylized facts must be manifested in its inherent logic for the model to be basically consistent with facts. The Black-Scholes model is one of the simplest models that have ever been suggested for option valuation, and it, as many other simple models in finance, applies the random walk concept and the normality assumption to derive inferences about future potential share price movements. What it suggests is that stock returns are normally distributed and that they have constant volatility. So every single day, the standard deviation is the same, the mean is the same, and the returns tomorrow are independent of the returns today. Utilizing this assumption, we can account for potential likely upsides and downsides of the share price and derive the value of optionality at a particular strike price. Without further ado, we need to estimate two key parameters that we would plug into the Black-Scholes model to estimate likely upsides and downsides, and those are D1 and D2. If you see here, those two formulas are very similar, with the sole exception of this sign. Here, the squared volatility times time is added, and here it is subtracted. Well, the logic is the following. This risk-free rate accounts for the time value of money consideration that, on average, stock prices are likely to appreciate in the future. This plus accounts for the fact that this is the potential upside, and this fact accounts for the potential downside. It's multiplied by time because, well, volatility scales linearly with time, and this term over here, the natural logarithm of the center price, so the share price at the start of the trading period divided by the strike price, notated as X here, accounts for how far away from the center price the strike price is. Because, well, obviously, if the strike price is very far away from the center price, it's less likely that the share price at the expiry date will be either in or out of the money, depending on whether you consider a call or a put. Without further ado, we could calculate those D1 and D2 values. So for D1, we open parentheses and first code the numerator. So natural logarithm of the center price divided by the strike price. And then we add another bracket, the annual risk-free rate plus the volatility, this is variance, so standard deviation squared, over 2 times maturity. And then we close the brackets, and that's our numerator. For the denominator, we need to divide by another bracket, which would consist of the standard deviation that is annualized times the square root of maturity. And here again we have the very same logic that variance scales linearly and standard deviation scales at the square root. So having applied that, we can see that our D1 is positive and roughly 0.06. Now, to calculate D2, we actually don't need to input the whole formula once again. What we can do is we can just copy the formula from this cell, paste it over here, and change this plus that corresponds to this added volatility term to the minus that corresponds to the downside or potential downside given the random walk in terms of D2. And here we see that D2 is negative and it's roughly 0.03. Now, given all of those inputs, we can just plug D1 and D2 into our fair value formulas. That can help us to derive the fair values of both calls and puts. And here we can see that those formulas, again, are very similar, and the only difference are the signs. Well, why is it so? Because, well, we know that call options are exercised out of the money, so when the share price is higher than the strike price. So here the sign is positive. We want the share price to be higher than the strike price for the call to be valuable. And here it's a minus because puts are exercised in the money. So we would like the share price to drop below the strike price for the put option to be valuable. So now we can input this formula for the fair value of the call option. So we multiply the center price by the standard normal distribution, norm as list, using T1 as our input. And we want to input the cumulative standard normal distribution here, so we put in 1. And then we subtract the strike price times the exponent of minus risk-free rate times maturity. That is basically exponential discounting that allows you to immediately discount by any rate for any time period. And then we multiply by the standard normal distribution of D2. And again, we need it cumulative. So this represents the potential of the stock price to move out of the money. So the fair value of the call then increases with this term. And this emphasizes the fact that the share price can also move in the money and then calls would not be exercised. And the logic is the same yet inverse for puts. So we need to apply this formula, and we see that the fair value of the call option is 23.18 pence per share. Now we can again just copy this formula and modify it slightly to get the fair value of the put as well. To do that, we just need to convert some pluses into minuses. So we need a minus before the first bit, reflecting this. We need a minus before D1. We need to convert this minus into a plus, and we need to convert this plus into a minus. And that transforms our formula for the fair value of the call into the formula for the fair value of the put. We pause the formula and see that the fair value for a put is slightly lower at 22.3 pence per share. Now, let's assume that our underlying assumptions change, and let's figure out how it affects fair values of calls and puts. Let's assume that our strike price increases. For example, it's now not 600, but 610. And we see that, as expected, the fair value of the call drops, and the fair value of the put increases. Again, just as we would have expected. Then, if the strike price drops to 590, for example, then the reverse happens. The fair value of the call increases and the fair value of the put decreases because, again, it's more valuable to buy something cheap, but it's less valuable to sell something cheap. Well, let's return back to 600, shall we, and test what would happen if the expiry date of the option is different. Let's assume that instead of 17th of April 2020, our expiry date is actually 17th of April 2021. So our maturity will increase roughly by 1 year. Let's see what would happen to option fair value given this scenario. Well, the fair value of both options have increased dramatically to 49 and 43 respectively. So the longer is the trading period, the more events can happen that would impact the share price, and it's more likely that the share price will move either in or out of the money. So when maturity of the option increases, it increases the fair value of both calls and puts. Returning back to this case, let's figure out what would happen if we reduce the maturity. So our expiry date would be closer to the present day of 24th of December. So, for example, if it's 17th of January 2020, what would happen? Well, the fair values of both calls and puts would drop, naturally, reflecting the fact that shorter-term options are less valuable because less movement is likely to occur for the underlying share price. And naturally, if we consider various changes in volatility, for example, if it increases from 1% per day to 2% per day, we have, again, respective changes, increases in option premium. If it, on the other hand, drops to 0.5% per day, then we have a respective reduction of option fair value. But now, the logic that can be applied in terms of whether we should buy or sell various options is to compare their fair values with their market prices. Let's see, the current option premia that have been in place on the market on the 24th of December 2019 are the following. So those are bid prices and ask prices. So the fair value of the call is much higher than the ask price for the call. It means that the call options are undervalued because their fair value is higher than the market price at which you can hold the option. Well, you always want to buy undervalued instruments in finance. So theoretically, you could profit from holding a call option for HSBC. But what about a put option? Well, for the put option, the fair value of the put is lower than the bid price for the put. It means that the put option is overvalued. Its price is higher than the fair value. Well, what it would mean is that you could theoretically write the option, the put option for HSBC at 28.5, and given its fair value is lower than that, you would theoretically profit from the transaction. And that was primarily, at least roughly, the underlying logic of one of the most famous investment companies in the late 90s, the long-term capital management. What they did is that they applied valuation models for stocks and derivatives and tried to hold undervalued stocks and derivatives and sell overvalued stocks and derivatives. Well, what is the main limitation of the Black-Scholes model that corresponded actually to the demise, to the failure of long-term capital management in 1998, was the fact that Black-Scholes model assumes the volatility to remain constant. And as we all know, that is not the best description of real-world financial markets. What happens sometimes is that there are periods of high volatility and the periods of low volatility. So if you have plugged in some historical volatility values into your Black-Scholes model and see that options are overvalued, it might just mean that the volatility the market expects in the future is higher than what was the case in the past. And that is what we can see now on the financial markets, when implied volatility, so the level of volatility that would justify the option premia that are currently in place on the market, are much higher than historical levels of volatility, which is unsurprising given in how turbulent of times we are currently living in. So beware of blindly applying the Black-Scholes model for your option trading, but still it's very useful to know at least the inherent concept to understand where those option premia come from. Please leave a like under this video if you found it helpful. In the comments below this video, please suggest other topics in business economics or finance that you would like me to explain in the future. And don't forget to subscribe to our channel. Thank you very much and stay tuned.